Well, estate planning helps to manage a person's financial affairs and control the distribution of their wealth after their death. But how do you do that amid a volatile market, recession fears, and high inflation? Let's bring in Providence Financial Insurance Services President Anthony Saccaro to discuss how you can think about your retirement and your legacy planning. Thank you for joining us. So, first of all, when we look at the main tenets of estate planning, what are the things that people should have in terms of what's on their checklist?
Rochelle, yeah, thank you for having me here. Certainly, the main checklist has to do with things to avoid probate after death and things to actually allow you to give other people the ability to control your financial affairs or your health affairs while you are alive. One of the biggest mistakes that we see people make is that they think that estate planning is only when you're gone. They don't realize that estate planning is also for the here and now. If you're a younger family, you need to prepare for your demise. What happens if something happens to you and you leave kids behind? Well, there's nomination of guardianship that you need to have in place to make sure that your kids are going to be taken care of by those whom you want to take care of them. So it's very, very critical to make sure that you have these documents in place. And it's not just for the rich, it's not just for the old, and it's not just for when you're dead. It's also for here and now as well.
And so when we're putting the pieces together, I mean, you have wills, trusts, probate, power of attorney, some advanced healthcare directives as well. How do you plan that when you do have so much uncertainty in the economy and you're trying to figure these things out?
Yeah, so I don't think we need to put too much emphasis on what's going on in the economy as to whether or not you should do estate planning. If the economy is good, you should do it. If the economy is bad, you should do it. If the economy is volatile, that really doesn't come into play when you look at estate planning or consider estate planning in general. You want to make sure that your estate plan is fully set up for you, regardless of where the economy is at. I think the bigger consideration as to whether you should have a will or whether you should have a trust is going to depend on a couple factors. The state that you're in some states, probate's really not that big of a deal. In California, where I'm at, probate's a huge deal. You want to do everything you can to avoid probate. So the state that you're in is a big deal, and the size of your assets. Each state has some type of statutory limit to where if you're under that limit, you don't even need a trust necessarily because probate is going to be very simple as well. So a lot of factors to consider state by state and the size of your estate.
And so when you think of how some of these stocks have had some really wild swings, if that's also part of the mix of things that you plan on passing on, how often should you update it? Or is there sort of language or contingency plans that you should put in there in case there are wild swings up or down in some of the stock assets that you have?
Well, when we talk about the stock swings, there's a couple of ways that we can consider those. You can look at gifting plans, and if you're going to be gifting stock as part of your estate plan, when the stocks go down in value, that's a great time to gift because you can gift shares at a lower price so that when they do come back, those shares and the value of those shares are out of your estate. So that's one way to look at it. Another factor when considering gifting or when considering passing on capital appreciated assets, whether it's real estate or stocks to your beneficiaries, is the estate tax threshold. Right now, the estate tax threshold is $12.9 million per person. So a lot of people aren't subject to that. But under the Trump tax rules that are going to revert back in 2026, those limits are going to go down to about the $6 million level. And so you want to make sure that you plan for the estate tax ramifications if your estate is over $6 million, even though right now the exemption is above that.
And when you look at the makeup of what people are planning on passing on, how much of it is, say, stocks versus, say, crypto versus real estate and other aspects?
Yeah, I think stocks and real estate are probably evenly combined. If you start to get into the upper echelons of wealth, people that are actually having to worry about that $12.9 million estate, that's mostly going to be real estate. And that's a great asset to pass on because you get what's called step-up appreciation as well, too, which means that if you have highly appreciated real estate, and you pass that on to your beneficiaries and they sell that real estate, well, they inherit it at whatever the value is at the date of your death. So if they sell it immediately at that same value, they don't pay any tax at all, which is phenomenal. And that's also true with stocks. And that could be a reason why you might want to hold stocks as well, but to pass on when you're gone instead of giving them while you're alive. If you give real estate while you're alive, you give stock while you're alive, you pass on the basis to the beneficiaries, whereas if you wait till you're dead, you get that step up. So that's a phenomenal way to pass on assets as well, too.
And so then just to wrap up then, what are the biggest mistakes, say your three biggest mistakes that you see people making when it comes to estate planning, which could make them sort of lose out, especially the people who are benefiting from it, lose out on some of these benefits?
Yeah, first of all, the number one biggest mistake is not doing any at all. We deal with a lot of people that are in the older half of life, the second half of life, that has just never even done it. And these are people that have lots and lots of money, lots of assets. That's a big mistake. A second mistake is doing it once and then thinking that it's just something that is one and done, that you never have to do again. We recommend every 3 to 5 years reviewing it. And almost every time we review an estate plan for someone, there's changes that have to be made, even though they were only done a few years ago. And 3 to 5 years goes by just like that. So it's a mistake not to review it frequently. And the third mistake is younger people thinking that they don't need to do it. You still need durable power of attorneys, no matter what your net worth is, no matter what your age is, and you still need your advanced healthcare directives. That is absolutely huge. Your advanced healthcare directive allows you to choose someone to make your medical decisions for you when you can't. Because right now it's illegal for doctors or nurses or medical personnel to give information about you to anyone other than you. And if you have a car accident or a medical emergency, you could be stuck with the doctors making the decisions and not your loved one. So it's a big mistake that younger people haven't done this for themselves. And don't forget about your kids that are 18. They have to have these too, or you might not be able to get information about them. Huge.
Certainly important, and especially considering the size of the boomer generation that's going to be retiring or perhaps selling their businesses and thinking of how to pass these things on. Lots of great advice there. Thank you so much. Providence Financial Insurance Services President Anthony Saccaro, thank you for your time this morning.